Hey, good morning, good morning, good morning, good afternoon, good evening, wherever you are across this country. Look, I am excited here to be on this episode of the Look Again Financial Challenge, folks. I have my friend, my mentor, my coach, my strategic partner that is helping me help you look again and discover some hidden truths and opportunities that are, quite frankly, are hidden in plain sight for many of us. But for those of you that don't know Mr. Jay Beatty, many of you do know him because he wrote the foreword on my book, the Look Again Financial Challenge. But this man is a absolute brainiac when it comes to the financial space. He's one of the thought leaders. He's just amazing in this financial space. He's been doing this for many decades, and he's helped people across this country, including me. So I have a special relationship with this man here, and I'm excited, honored, and thrilled every time he's on my platform. Today, we're going to talk about it's a deduction in Roth conversion, something that 99.9% of you watching this probably have never heard about. And I think I want you to take a moment and pause, get rid of all the distractions, and I want you to lean in and listen to this particular interview because this interview could be life changing for you. Absolutely life changing. So without further ado, Jay, thank you, thank you, thank you. Welcome to the Look Again Financial Challenge platform. How are you doing this morning?
Michael, I'm always doing well when I'm with you. Although I hope you didn't set the bar too high with expectations here.
Never, 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 never. So, folks, with you, I understand we all are adult learners and we have a lot of moving pieces in our lives. So, I want to get straight to it. And we're going to do this kind of interview style. And I'm going to ask you some questions, Jay, that I think will resonate with our audience here. But when we talk about the Roth conversion, usually when I'm dealing with clients and I'm talking about Roth conversion, they have that fundamental question or that resistance to the Roth conversion. And can you share with our audience why most people are hesitant to even consider the Roth conversion?
Very simple. Nobody wants to write a check to the IRS. But I think, but before you get to the decision of, should I convert, you need to understand kind of what the implications of both options are. If you stay with a traditional IRA or 401k or whatever kind of qualified plan you have, if you stick with that, you're going to pay taxes at the highest rate. You'll pay them over the course of your lifetime. Your kids will pay taxes on whatever's left over at their tax rate, which is likely to be higher than yours. And your money's exposed to future tax rate increases. Okay, that's your default option. Do nothing, that's what you get. When you consider Roth conversion, we talk about 7 risks that are inherent in a traditional IRA, all of which go away when we convert to Roth. And if I won't go through those now, but if you study what those 7 risks are, I'm sure you can share with people what they are. If you study what those 7 risks are, and you're able in one fell swoop to wipe them all off the table, that's a huge advantage to begin with. So the mere fact that Roth conversion takes those 7 risks and vanquishes them should be motivation enough for most people to consider conversion. But the thing that always gets in the way, as you say, is the proposition of writing a big hunted check to the IRS. I mean, nobody wants to do that. Nobody wants to do it voluntarily. Nobody wants to do it a minute before, the government squeezes it out of them. But there's actually some advantages in going ahead and kind of ripping that Band-Aid off and getting that thing converted over to Roth, because the backside is where the real value is. The post-conversion side is got tremendous potential to substantially increase your wealth, particularly if you can kind of convert using some of the strategies that we talk about.
Wonderful, wonderful, wonderful. So Jay, with that, I know many of my listeners are chomping at the bit to be able to ask the question. Mike, have Jay talk about what is this reduction? You mean to tell me that I can get a reduction in my Roth conversion legally?
Yeah, I mean, there's a strategy that we use. It's got a few moving parts. It's not, Maybe not for everybody, but for most people, I think when you understand the mechanics of how we achieve the discount, it becomes pretty clear. You go, okay, yeah, that makes sense to me. I see how you can do that. Typically, Michael, the discount is going to be in the range of 40%, and that's a discount on the conversion tax. So let's just take a simple example. If somebody had $100,000 in a traditional IRA and they were going to convert, and their tax accountant told them that if you convert, your tax rate's going to be 30%, and your tax bill is going to be $30,000 on 100,000. If we reduce that by 40%, then the tax bill goes to 18,000 instead of 30,000. So yeah, those kinds of reductions are pretty routine for us to achieve in the conversion process. Now, again, if you put an extra zero on that and consider taking the tax bill on $1 million IRA from 300,000 down to 120,000, that's pretty substantial. Those savings are very, very meaningful. But what you don't see, what's hard to see, is okay. That means by definition, my Roth IRA, my resulting Roth IRA, starts out with more money in it than the after-tax value of my unconverted IRA would, or the value of a conventionally converted IRA would. So when we start out with more money in the Roth, that money is going to be used either to compound and grow my rainy day fund or grow my legacy value, or it's going to be used as an income source in retirement. Any way you cut it, starting off with more money means you're going to end up with more income, more legacy value, a bigger rainy day fund. So what we try to do with clients is get them to see the conversion tax not as an expense, which is how everybody looks at conversion tax. I don't want to write that check to the IRS. I don't want to do it voluntarily. I don't want to do it before they force me to. Why? Because you look at it as an expense. An expense is when I take money, I give it to you, and I never see it again. We encourage our clients, or we create a scenario where our clients can look at that conversion tax not as an expense, but as an investment. And like all investments, they should and they do expect a return on that investment. The return manifests itself in the value that converted Roth IRA will yield for them as income or as wealth over the remainder of their lives. And oh, by the way, 10 years up to 10 years after their lives, when their kids can inherit that Roth IRA and continue to grow and compound it for 10 years before they got to take it out and put it back into tax circulation. So long-winded answer to your question, but yeah, the conversion, the discount on the conversion part is easy. What's really important is to understand what that means to me on the backside of conversion, and it's substantial. And when we do Roth conversion case, we show people exactly what substantial means in dollar terms. We're going to show them what the back end means over the course of their lifetime and beyond. And it's compelling. I mean, if you imagine this, Michael, if you converted your traditional IRA to a Roth IRA using our strategy, and the net result, all other things being equal, life expectancy, return on investment, all those things being equal, if the net result is you were going to have $100, $200, $300,000 more wealth during your lifetime, and another $100 or $200 or $300,000 that would pass on to your kids tax-free, that they could continue to operate tax-free, would that be meaningful? Well, I don't know anybody whose life that wouldn't change. So yeah, those kinds of outcomes are routinely available.
Wow. Wow. Folks, I hope you hear that. For those of you that are just joining us here, we're here with none other than Mr. Jay Beatty, renowned author, speaker in this financial space, one of the great minds in this space. He is talking about, if you have not joined us, talking about his Roth conversion strategy that can really save you almost 40%, nearly 40% on your Roth conversion. And that's the easy part. That's the easy part. But he's talking about the value proposition that you will be able to enjoy the rest of your life. And you can pass down to your generation, the compound on these savings here. So Jay, the average listener is saying, okay, 40% discount on my Roth conversion. It has to be a catch to this. This has to be for uber wealthy people. This has to be for this. This is too complicated for me, too complex. I don't have time for this. I don't want to get into, it's just too much. What do you say to that individual that says, this may be too over my head, too complex for me. It may not be for me.
Well, I think we've got to acknowledge the reality that for some people it will be, and not press them into something they're going to be uncomfortable with. But I think the important thing is look, that 40% is going to result in a number, right? So you're going to take the size of your IRA, your tax rate, multiply the two together, and that becomes your conventional conversion tax. You reduce that by 40%, whatever that savings is, that's your number. Okay. Now that's likely to be a big number. It could be 20,000, 50,000. It could be 300,000 in savings. So now once you see that and you see what the backside means, if I start out with a Roth IRA that's got, $50,000 more in it than it would have had I not converted, and you see what the future value of that extra $50,000 is, again, whether you're going to use your IRA for income, for legacy value, for rainy day fund, whatever, then only then should you make that decision. Because sometimes things that seem complicated, when the payoff is big enough, we endure that complication, or we figure it out, or we decide I'm going to charge through it. I'm going to figure out, because I want the brass ring that's on the other side. I want that extra $200,000 or $300,000 for me and my family. And if that's the case, you can take a lot of people who would look at, if we just describe the mechanics of how the process works, I'd say, man, that sounds like a lot of moving parts, too much for me. But if they say, yeah, there are a lot of mechanics, a lot of moving parts, but I see that extra $300,000 down the road, and I'll figure out the difficulty of the moving parts because I want the 300,000. My family wants the 300,000. I owe that to myself and to my family. That 300,000 would otherwise is going to go into the hands of other people. It's going to go to the Wall Street food chain. It's going to go out in taxes. So if you're motivated enough to capture that, what would otherwise go out to others, and reclaim it for yourself and your family, I think you can endure a lot of mechanics and things that might on the surface seem a bit complicated and complex. And by the way, it's not that complicated and complex. Once you kind of see it, the front end, getting it all done, there's a few hoops you got to jump through, but once it's done, the go forward, frankly, is simpler than having a traditional IRA managed through a traditional custodian.
Thank you for that, Jay. Earlier, I was on a similar platform. I had one of our clients on here that was speaking about this process that he was able to go through, and he used the phrase seamless transition. To me, that shows that, hey, he said all of the heavy lifting was done by the professionals. They just engaged him in the process, kept him informed, and he had to sign a few things, but the whole process was both educational and seamless. Some of the things that keep a lot of folks from doing things is that they perceive it to be too much work, too complicated. But we're sharing with you that if this is something that you want to investigate further, that it's not that difficult, folks. And the saving component alone is going to move the needle in your life. So, if you want to connect, if you want more information, obviously we're going to have some information below where you can connect, and you can get into our ecosystem, if you will, and we can give you some information and give you some information. One of the things about the Look Again Challenge I always say is that we're going to help reason through to a solution, like Jay said, that may include you doing absolutely nothing at all. But it's hard to see things, folks, that you're unwilling to look at. Hard to see what you're unwilling to look at. And this is something that I think, in my opinion, I believe everyone ought to at least look at, investigate. So the last question, because we're not going to be long-winded, because I know you have a lot to do and a lot of clients, Jay. But here's the question. I think I may have touched on it a little bit. Michael, it seems too good to be true. How do we know that this is something that's on the up and up, that we can get involved with, and that we won't, that's legal, for lack of a better phrase?
Well, again, without getting into the details of what the process looks like, I think the short answer is that the valuation methodology that we use for LLCs that results in the discount is a function of a policy that the IRS has actually published. So if the client wants to and is really bored and having trouble going to sleep, we can provide the 116-page IRS manual that shows valuation experts how to conduct the valuation of the IRA that results in the discount. So that publication is a result of 50 or 60 years of case law, and it's kind of where the IRS has settled and said, okay, guys, instead of fighting this out all the time, you use this rule set and you're good to go. And that's the Bible that we use in order to do the valuations that result in the discount. A few more pieces to it than that, but that's really the bottom line. So, and again, we encourage anybody. We've got documentation, we've got legal opinions, we've got the manual itself. If somebody is questioning that, we absolutely encourage them to bring their tax accountant in or their attorney into the conversation, so that they're 100% comfortable before they do anything.
Thank you, folks. Once again, and we're about to let Mr. Beatty go. I know he has several appointments this afternoon, but I wanted just to recap here. We're talking about the Roth conversion. We're talking about nearly a 40% reduction in that Roth conversion. And I want you to think about the Roth conversion on the surface. It does not cost you anything. All you're doing is dissolving the partnership with Uncle Sam. You're taking what belongs to you and you're giving them what belongs to them. That, quite frankly, belonged to them since the very first day you put $1 in that qualified fund. And by the way, taxes are probably historically as low as they'll probably ever be. So this would be the time to do that type of conversion. But on top of that, the bonus, you get a 40% reduction in doing so. And then,
Michael, if I could jump in real quick, because you hit a very important point there, and that is the idea that a traditional IRA, a 401k, whatever plan you've got, it is a partnership, and your partner is the various taxing authorities. And the nature of that partnership, when you set it up, when you first put the first dollar into that partnership, here were the terms of the partnership. You put up all the money, you take all the risk, you pay all the investing fees, costs, and commissions, and sometime down the road, I, as your partner, will tell you what portion of the partnership I own and what portion you own. And I do that through the taxing policy that's in effect at the time. Now, the reality is, Michael, I don't think a second grader would open a lemonade stand with a partner under those terms and conditions, but that's exactly what we've done. That's the bad news. The good news is that if you see it in that light now, the good news is that you've got one unilateral trigger in that partnership that you can invoke that takes that partnership, dissolves it, and turns it back into the sole proprietorship it should be, where you own all the money, you make all the decisions, and you reap all the rewards. And that is Roth conversion. And you have the unilateral ability to pull that trigger anytime, any day you want. So if the idea of being in a partnership under terms like that is nauseating, and you can take the dissolution cost, if you want to look at it that way, the tax, and get that in your mind as an investment rather than an expense, and generate a return on that investment, I don't know. Seems like a lay down to me.
Folks, I mean, we could drop the mic there. Enough said. Once again, Jay Beatty on here bringing hidden truths and solutions to the forefront. If you want to connect with me, when you connect with me, quite frankly, you connected with my strategic partner, Mr. Jay Beatty, who also wrote the foreword on my book, The Look Again Financial Challenge. He's both a coach, mentor, friend, and business partner. So, folks, use us. Use what we have to bring to the table to at least put yourself in a situation where you can, in fact, look again. Thank you, Jay, so much for sharing your knowledge here on our platform. We can't wait to have you back on our platform.
Look forward to it, Mike. Thank you.
Thank you. Appreciate you.